Order blocks, the most effective price action trading strategy. In today's video, we will simplify the only fundamentals and techniques you need to know to incorporate this smart money concept into your trading routine. So what is the order block? We have two chapters to cover. The first is the fundamentals of the order block. The order block is an area of manipulation formed just before a significant price movement. Traders see these zones as areas where a large number of buy or sell market orders have been executed. So by knowing this information, we can potentially take advantage of higher probabilities of trend reversal when the price hits these areas. Now on to the second chapter, which is the structure of the order block. In a bullish market, the order block is the last red candle before price aggressively goes to the upside. The order block candle usually breaks the last low of the previous candle, taking its liquidity to push higher afterwards. In a bearish market, an order block is now the opposite. It is the last green candle before price aggressively pushing to the downside. The bearish order block candle also usually sweeps the liquidity of the last candle. There are certain rules that needs to be respected in order to consider an order block as being valid. The first rule is, as we have said before, the order block candle must sweep the liquidity of the past candle. This indicates that institutions have successfully taken the liquidity of the retail traders, loading all the liquidity for an upcoming massive reversal, as seen in the following representation. The second rule is the order block must leave a gap as a market inefficiency indication above the order block. Such in this situation, we see the liquidity sweep and the gap above the order block. This combination indicates that institutions have left a significant inefficiency that they have to fill later on. And the order block being the institution's entry price that we want to follow. The third rule is that the order block must be unmitigated, meaning that the order block must be used only once per setup, and the same order block cannot be used for a second setup. As an example, in this setup, we have the following bearish order block. And we see that if we took a sell short setup, just like we usually do with a stop loss above the order block and the take profit below the last swing high, this is a winning trade, this candle closing our trade with a take profit. But if we took another sell short from the same order block, the second time, we would have gotten a stop loss by this candle, losing the trade. So it is very important to not reuse order blocks, and order blocks that have not been yet used are called unmitigated order blocks. The fourth rule is that it must follow the structural trend. In the bullish scenario, it rallies, then base and rallies again, taking the last swing high. So we know we are in an uptrend. In uptrends, we do not want to look for bearish order blocks, as it will easily liquidate our positions, taking our stop losses. What we want to do is looking for bullish order blocks. At the retrace of the movement, the unmitigated order block gets filled, creating an impulsive move to the upside while also forming another unmitigated order block that we can use later. Being in an uptrend, we consider that price is more likely to break the last swing high, so that is what we are targeting. Then price retraces to fill the other order block. And the process repeats. In the bearish scenario, it happens the exact opposite. Price drops, base up, and breaks the last low. This confirms we are in a downtrend, forming a bearish order block. Price base up into the order block to mitigate it, then breaks the last low, confirming another bearish order block that will later get mitigated. And the process repeats. The very important rule to remember is that on a downtrend, we do not look for bullish order blocks, because if we do that, we are fundamentally and structurally trading against the trend, leading to higher chance of losing. Now on to live trading examples. We clearly see we are in a downtrend, so we want to look for bearish order blocks. This is last up candle that sweeps liquidity before the move to the downside. We mark the area as our bearish order block. And we short with a stop loss above the order block and the take profit below the last low. Here we have entered the trade. And that was a quick win led by this candle. Here we see that we are in an uptrend, So we are waiting for bullish order blocks to get formed and pay attention to recognize the pattern. This is our candle that has swept liquidity, and we see an aggressive afterwards, therefore is our order block. Price has mitigated our order block. We now look to buy long with stop loss below the order block and take profit above the high liquidity point. Here we see another order block formed into the micro trend. We could also use this as a second position. We buy long with stop loss below the second order block and take profit above the structural high. Our first trade has hit take profit. Now we wait for our second order block to get mitigated. Here we have entered the position. Wow, what an impulsive move. We have hit take profit by the next candle. This candle can also be taken into consideration as an order block since it sweeps the liquidity before an impulsive move. But it is not a good quality order block because it doesn't really respect all the rules. If we would have taken this position, we see it hits as a win. But the risk to reward ratio is very low, and in the long run, we need a higher win rate to compensate. So we do not want to take such setups. Let's take a look at the next example and explain the next thing we want to avoid. The order block gets formed here, so we mark the zone and we wait for institutions to mitigate and use the liquidity to enter bigger positions so we can follow their footsteps. Oh, why did this happen? That is an instant loss. That is because this move was caused by high-impact news, times where market makers fight each other and some try to front-run the news release. We usually want to look at the economic calendar and avoid trading near high-impact news as it instantly lowers the quality of our setups. Now these are the entry types that on the order blocks, we can enter right at the touch of the order block. This is the most common entry type for a good reason. It gives you a good enough risk to reward ratio while also having lower chances of price missing your entry. The second type of entry is at the half of the order block. We see that this leads to a higher risk to reward ratio, but we will have fewer entries since price could often hit the top of the order block. Practice and see which one do you prefer.